Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets. Ice raw sugar in New York. The past key influential feature here had been and continues to be the late April to late August descending expanding wedge pattern, currently 121.22 right off the bottom of my daily chart, and it's highlighted in dark blue on my daily chart. This morphed from an original sideways triangle into a descending wedge pattern, and back in late August, the market broke out over the upper trend line of this pattern. However, the move up got caught within congestion from early May, late April, and from the bottom end, the March 2012 high at 26.20. This halted the rise, but prices did not turn wholly back down. Rather, the short-medium moving average, currently at 26.81, acted as a support at the start of October. And though prices appear to be caught for a while, between the March 2012 high at 26.20 and the high of last April at 27.42, they eventually grinded their way higher. In part, I suspect the weekly key reversal up made from 3 weeks ago prompted this move higher, though it was only 2 Fridays ago that we had a first close up over the significant congestion at 27.71. Last week, I was awaiting confirmation of this pop upwards, and though we had 2 consecutive closes over 27.71, the move up has seemingly not been sustained. You see, further above we have a small band, 28.27 to 28.36, which contains the October 2011 high at 28.36, and the market shied away from testing it last week. In shying away lower, the market has made the secondary target X1 at 28.75 a much harder to reach target for the descending wedge pattern, such that I'm considering possibly retiring it. We had already seen a primary target in the 27.25 area reached in mid-September. The move lower has also offset the idea put forward last week of a small October-based ascending wedge pattern, currently 27.84 to 28.74. I will retire this pattern idea after this commentary and ponder a little longer on what is going on here. Ice Europe white sugar in London. The break higher over the upper trend line, currently at 686.60, back in late August, of the late May to late August expanding wedge pattern, set the stage for the next move higher, though it wasn't an easy delivery. This was a multi-pattern move, as the upper trend line was also the neckline for the late May to late August reverse head and shoulders pattern. Thus, a primary target for the expanding wedge pattern was in the 769 area, with a secondary hard to reach target X1 up in the 797.30 area. Meanwhile, the primary target of the reverse head and shoulders pattern was in the 754.20 area, with a secondary harder to reach target X3 up in the 784.90 area. As you can see from the daily chart, the primary targets for the descending wedge pattern and the reverse head and shoulders pattern were both reached in September, leaving those harder to reach, much harder to reach, secondary targets still live. There has been for a while a question mark over these secondary targets, as after reaching the primary targets, the market changed and dropped back away in mid-September to early October. Eventually, the climb was halted by a combination of the rising short-medium moving average, currently at 731.20, the rising medium moving average, currently 708.10, the original broken trend line, currently at 686.60, and the congestion between about 675 to 700, dating from July to August, and again earlier from June. This had been enough to turn prices back up in early October, with a little mini reverse head and shoulder bottom pattern, and prices have reluctantly and slowly moved higher, making a new high last week, one not seen since September 2011. Below, we now have congestion at the April high at 730.5 and the October 2011 high at 735. Now, here, as in New York sugar, the action over October going into November had elements of a possible ascending wedge pattern, currently 737.40 to 764.90. But unlike the New York contract, here we have not seen a break lower, and the pattern still seems valid, despite a breach on the upside last week that was quickly repaired. The September high at 769.10 still seems to be the main obstacle on the way higher, but just keep in mind that we still have open targets higher up. Sugar Wipes Premium Spread. We are in the last quarter of 2023 and this chart continues to be one of the busiest and most colourful of all my daily charts, or actually weekly charts even. Many things are still going on, all at the same time. Okay, so I'd previously spoken some while ago about two big picture items I'd seen here on this weekly chart. We have the recurring big old bullish Andrews pitchfork from 2019 to 2021, highlighted in dark blue on my weekly chart, with the market at the moment in between the lower time below, currently at 117 3/4, and the middle time above, currently at 192 even. I've said this so many times before, and I will repeat it here yet again. This pitchfork, despite being breached in the past, still continues to show the overall major bullish angle of attack of this market. Next, we have an ascending expanding wedge pattern highlighted in bright red trend lines and above the market. This was formed between mid-April to late November last year, currently at 215 1/4 to right off the top of my weekly chart. To me, was and still is not the best looking of such wedge patterns, but it is also still out there, despite being tested as recently as mid-April this year, and it comes with all the possibilities such a pattern invokes. Then there is the most recent activity, and this had seen prices around and through, on occasion, all the moving averages. Notably the long moving average, currently at 131 even, and the medium moving average, currently 141 1/4. All prompted by the gapping change move lower of a few weeks ago. We have seen this activity push prices down through the two 50% Fibonacci lines at 128 3/4 and 131 1/2, as well as the June 2020 high at 134 even, and then move back through all of them as well. And then last week, gap higher with a weekly indecisive spinning top that was supported by the medium moving average below, currently at 141 1/4, and capped on top by the 2013 high at 152 3/4. This gap has left an island below between early April to early November this year, and last week reached the top side target in the 152 even area last week, the same week it gapped for a second time. It all now depends on what the market does with the overhead 2013 high, because beyond that we have the neckline, currently at 158 1/4, highlighted in pink on my daily chart, with the June 2021 to May 2022 reverse head and shoulders bottom, before we hit the congestion between 162 3/4 and 165 3/4 that contains the 2012 high made back in July that year. Now, many weeks ago, I drew a bullish shift pitchfork for the August 2021 to February 2023 action, and I once again decided not to highlight it, as with already so many trend lines here, the action on this pitchfork neither adds nor subtracts from the current picture at this time. The next point I'd like to discuss is once again a previously discussed big picture item. It's looked once more at the whole of the 2022 action as a possible huge lopsided diamond pattern, out of which prices have emerged during the summer. This is the pattern that is highlighted in green on my daily chart. We initially had a false break higher from this pattern, then recently a false break lower, and so far the market has still not decided as to which way this pattern will drive us. Last week I began to have doubts about the whole idea, and I can see myself retiring this pattern completely unless we see some productive activity in one or other direction.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Toftbig and ADM Investor Services International Limited. And here comes the final important bit.